It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Well, it's the final sprint before the tax filing deadline. So what needs to be on your tax checklist before last year's taxes are due? We're hitting that plus the top tax planning strategies for 2026 on this hour of the Wise Money Show.
Nerd alert. Yep, that's what we're talking about today. But listen, the whole idea is so that you don't pay as much in taxes as you otherwise would. Tax planning, the proactive work of figuring out the strategies that fit within all 6 areas of your financial life to pay the least amount of tax, sometimes this year, but sometimes out there in the future. It's not just nerds that are down with that. So we're going to help you with that. If you have a question for the program, we'd love to hear from you. You can call or text us, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can leave questions as well. And then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. The YouTube channel gets a lot of questions, a lot of comments as well. So make sure you go check us out there. Okay, guys, so April 15, right around the corner. That's one of the deadlines that you need to be aware of. And yes, it is April 15 this year. It's not on a weekend. It's not on a special DC holiday. April 15 is tax day. What are some of the other dates to be aware of?
Well, keep in mind, April 15th, you're filing last year's taxes, or if you're not ready to file, then you're filing an extension. That buys you up to another 6 months to get your taxes in. But here's the issue. If you're going to owe some money on your 2025 tax return and you want to extend it, you're going to postpone the filing, the taxes are still due on April 15th. And we all know April 15th is a painful date, partially because if you still owe something for last year, you got to pay that up. But then it's also time to start paying on the current year.
Double dip. This feels awful because especially if you believe, I need an extension, i.e. my taxes are probably complicated. I'm going to owe. Yeah, that probably means you need to start paying estimates, and that's also first quarter estimate is on April 15. So you got to jump on all that. And by the way, you've got to, we would encourage, we're going to talk about this more, but the IRS is starting to go checkless, paperless. And so we're in a transitionary phase. Yeah, they're not saying they'll reject your check, your mailed check in the mail, but they might in the future, and they want you to make those payments online. So go to irs.gov/payments. Mm-hmm. And the good news is from that site, it's only 15 more clicks. And I might be lowballing it there. They have made it very complicated to make those payments, but hopefully that gets better. But okay, so that's one day.
And you have to have this rhythm down, because if you're new into retirement or something has changed fundamentally in your financial life where you're no longer receiving a paycheck as your primary way of paying into the tax system each pay period, quarterly estimates are something that you got to have a routine for, potentially, unless you and your certified financial planner use another method that maybe we'll get into later in the show. But know the dates. Yes, April 15th is when it starts, but it's only 2 months later that we say it's time for another quarterly payment.
Yeah.
So these things do not line up with the calendar quarter. After that, then it's September 15th, and then you wait all the way until January 15th when the fourth quarter is due. So not equally spaced out. One of them even spills into the coming year. And so this messes a lot of people up. We wouldn't be talking about this if it didn't trip a lot of folks up. They miss them along the way. They're late, that sort of thing. But again, if now's the time for you to be filing an extension, just know that postpones as late as October 15th when you can get those returns in.
So I think in terms of tax due date, when's my tax due date? That is April 15th. That's the last.
Yeah. The dollars themselves.
Dollars themselves. When's the tax filing deadline? Well, it's April 15th, but you can get that automatic extension. Yeah. But this is how a lot of people, especially small business owners, can get really kind of messed up because, to your point, Josh, if I've got to make a payment for last year, I owe based on my income for last year, and I've got to make a payment based on what I've made in the first quarter. If I've got the cash, You say, well, you made the money, you have the cash. Well, if you ever run a small business and you've made the money and you don't have the cash, that puts you in a tricky situation.
Or, businesses are seasonal and cyclical. If the first quarter is not your money-making quarter, then you're stacking up IOUs. And yeah, that can be but you can get out ahead of that. You can. And even if you say, no, I am behind and I am in that sort of tax cash death spiral as a business owner, no. That's not your fate. So go. So Kevin, stealing your words here, run, don't walk to your certified financial planner. They can help. It's not a quick fix or magic bullet, but they can help. Okay, so every time you're filing your taxes, you got to answer 3 questions before you actually file that return. And the first one is, do I understand why I got the result that I did? And this is just your safe double check to confirm, I added all the interest in there, all the sources of income, those are there. I've got all the deductions that I'm supposed to get. And even if that's not your bag, if you don't like that stuff, doing that with your CFP, they'll just do the double check and that's great. Second then is where the magic happens. And that is there anything that you can do right now before you file that return to improve last year's return? So guys, we still have a week left or so. And if you haven't filed, you have an opportunity to do these things. If you have filed and kind of pinky swore, yeah, I'll fund it, I'll do it, you now have to do it. What are those things? There's 5 end of season tax moves that you can make.
The one that's always on my personal checklist, and I'm treating this as my own personal reminder, actually, health savings account contributions. If you're contributing out of your paycheck, but you're not fully funding it throughout the typical year, you have an opportunity to go back and still finish funding it for 2025 up until April 15th. So you have time to just make sure that you've got all the dollars into the HSA that you can. Why would we pay a special attention to that one? It's mostly because it's one of the few places where you get 3 tax benefits in one. You're going to get a tax deduction by making that extra contribution. The money can grow tax-free. And when you pull the money out for the purpose of reimbursing yourself on medical expenses, it is also tax-free. Rarely can you say anything that powerfully about a tax saving strategy like the HSA.
Yeah. You're going to want to make sure, we've talked about this risk before, and this is where, Josh, I'd give you a little tongue lashing there, old fashioned, that, buddy, get that thing funded by the end of the year. And yes, you have up until April 15, but if you're making your contribution online, most institutions don't even have a drop down, a button for you to say, oh yeah, I'm making this contribution online and I actually want it for 2025. I want it for last year. Most of them, if you're doing the online transfer, it's not even going to ask you. And so then you might say, well, okay, then that's fine. I'll just tell them, they're going to automatically assume it's for 2026. And if you want to have a pointless arm wrestle with the IRS, do that.
Yeah. So the HSA compliance is really the wild, wild west. It's easy for someone, not to defend Joshua, but it's easy for someone who has ownership in a business. They can't contribute via payroll.
Over 2%.
Right.
Yeah.
And so if you own over 2% of a business, you can't contribute via payroll deduction. And so therefore you have to try to keep up with the changing contribution limits constantly.
I know.
And so you're like, no, I want to set it and forget it. And I want to invest monthly and on dollar cost averaging, blah, blah, blah. No, you got to fix that once a year. And then you think, oh, I fixed it last year. And I'm like, oh, no, that was 3 years ago. And so this, when I started in the business, there was an IRA, period. There wasn't a Roth IRA. There was an HSA, and you could put $2,000 a year into it. That was simple. Like I could track with that, and now everything has gone nuts.
So HSA, and I know I'm teasing Josh, but that is absolutely at the top of the list and an easy one because of those tax advantages Josh mentioned. Along with the HSA, you can do a traditional IRA contribution for last year. The traditional IRA, you've got 2 ways you can handle that. If you meet the criteria, meaning you've got earned income and you're not contributing to a retirement, you don't have a retirement plan through work, or your income's below a certain threshold, you can contribute to that IRA and get a deduction on your return. You have up until April 15 to do that. Or you could also contribute to an IRA if you have earned income, but you're over those other income thresholds, and just not deduct it. Have it be after tax. This is kind of step one of the two-step backdoor Roth. Or you just say a future backdoor Roth. I want to have these dollars grow tax sheltered. So traditional IRA contribution as well. That's two. They've got three more of that, more coming up here on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time every Saturday morning, and also on podcast at the same time. Also on a couple local radio stations at the same time as well, which is why the content's broken up the way that it is. We've got segments, and we try to make those entertaining for you and have bonus content as well. But we've got lots of other videos that air right here on this channel. Now, the library is over 2,000 videos, all designed to help you take your next wise step in your financial life. So hit that subscribe button, turn on notifications so you're made aware every time we drop new content, and leave questions and comments below as well. We appreciate it. Want to know right now, question for this show, are you funding pre-tax or are you funding Roth? Want to hear it. My guess is the majority are going to say funding Roth because they're fans of Michael Paul Roth Bernard.
Well, I think I can be a fan of Michael Paul Roth Bernard and still put money into my traditional side.
Hey, listen, if you're splitting the difference, love to see that as well. Makes a ton of sense. Did a video on next wise step video on that as well, that strategy. Well, let me ask you guys this. Here's a little bonus content if you didn't see the video. The game plan that I think is akin to the play action pass. Like it always works. If you do it every play, okay, they're going to be onto it. But the play action always works. That was the max my 401k pre-tax and then max my Roth. Max it pre-tax and max my Roth. I feel like the past few years that has shifted. It's still a fantastic strategy. More and more people are max my Roth 401k and max my HSA. Have you seen a shift in that game plan? The play action pass here?
I don't know if I would say like it's some universal thing that I've seen. It just depends on each client situation.
I can't remember the last time I've seen someone max pre-tax and then max Roth.
Yeah, I mean, the challenge is if you can max your 401k, it's likely your income is high enough that you can't fund a Roth. Now,
and that's why, and not to interrupt you,
the Roth limits have gotten a lot bigger.
But that's why I've seen this shift because, yeah, even with high income, those folks are saying, you know what, these tax rates are low. I want to fund my Roth 401k because I can't fund a Roth IRA. And where can I get a tax deduction? It's my HSA. So let's do that.
Mm-hmm.
So what is that? The hook and ladder? Like, I don't know. What did Newt Rockney?
The Hail Mary.
Newt Rockney had 4 plays. Is that right?
I don't know, but we ran an I formation, so you got 3 guys across the back.
That was Tecmo Bowl, by the way.
And there was a play that every time Scott Shell threw the ball to John Tasha and he was open and he scored.
Really?
But they only ran it a couple of times during the game. Mm-hmm. And it was amazing.
That's like when Edwardsburg throws the ball. It's a trick play every time.
Yeah.
What do you mean?
Like, when we throw, did I say run or throw?
No, when they throw the ball, it's a trick play.
Because we run every single play.
Yeah.
Except maybe twice a game when we're a little bit desperate or we just need to trick them.
No, it works, right?
But we need to make a pass.
I remember coaching flag football, and the pass plays were called turnovers. So it's like, hey, all right, we're tired of running the ball.
Right.
Let's give it to the other team.
Our offense needs a break.
Listen,
let's throw a pass, and for sure the other team's going to have it.
There is one weekend during the football season that I always am nervous, and that is Notre Dame Navy. Like it's just because it's like any other game. You're like, yeah, I mean, we should hopefully win, but if we lose, maybe they were a better team. And not with Navy. You just always think, no, we're bigger, and we should beat them, and yet they've got that run first and whatever it's called.
And
I've heard it called like 4 different things. So all right, here we go. So we hit Roth IRA, we hit HSA traditional IRA.
I don't even think he heard you.
I did.
Why aren't you laughing? That
He's
was
jealous
Because I'm trying to get my game face
he's
on.
the
We're talking
ultimate
sports.
dad joker, and he's mad that he didn't come up with it first.
Game face. We gotta. Someone's got to be the mature one here.
Yeah, that'd be Lindsay.
Yeah, that's right. That's right. All right, here we go. For 2025, what are some things that still should be on your maybe last minute now tax checklist before April 15? What can you do to improve last year's return? We're helping with that right now. This is the Wise Money Show with Cohorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Cohorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. All right, before you file your return, and if you've already finished your tax return and you say, okay, I don't even need to listen to this, hopefully you answer this question. It's question number 2 out of 3, and that is there anything that I can do right now before I file my return to improve my tax picture? Okay, there's 5 of them that we're hitting. 1, HSA if you're eligible. 2, traditional IRA if you've got earned income. You can either fund that pre-tax and get a deduction for it, or after tax. And there are times, even if you're not doing a backdoor Roth, where you'd still want to do that. Creatively work with your CFP on that. Roth IRA, of course, that's the 3rd one.
Right. And let's just clarify. You kind of frame this as what can I do to improve my tax picture? That doesn't necessarily mean this year's the tax return that you're filing will remain unchanged when you make a contribution to a Roth IRA. The point, though, is that you absolutely are improving your overall tax picture in the long run. You're positioning dollars that can be growing tax-free forever. You're putting yourself in a powerful spot when you get to retirement, and now you have a pool of money that you can draw on completely tax-free. We love the Roth IRA. And if you haven't funded it for 2025, there's still time. And you may consider doing that. Maybe you've filled up all of your tax buckets and you've got resources to bless other people. Let me know. You can do a Roth for me. Or maybe you've got kids or grandkids where you want to get involved in literally shifting wealth to future generations.
So you bring up a good point. And we've gotten this question comment actually from folks before. When you make a Roth IRA contribution, do you need to report it on your tax return? Technically, no. I want you to. We want you to. Mm-hmm. It doesn't need to be on your Form 8606. When you do an after-tax IRA contribution where you don't deduct it, yep, that needs to be on your 8606, as well as Roth conversions. However, when you start doing Roth conversions or start pulling or doing after-tax, like some of the more complicated, on your 8606 needs to be your IRA contribution basis. And so it needs to be on there, but it doesn't need to be reported on an 8606 every single year. It's going to ask you in your tax software, your CPA, they're going to want to input it in so that they can track it in the future, whether it impacts your return or not. But the second reason why we would say make sure you still run those miles and put it into the software, tell your CPA. We see a lot of people who, yep, I've been funding the Roth IRA every single year, and without knowing it, their income this year is above the limit. They can't do the full Roth contribution. Now they've made too much of a contribution. There's penalties and there's cleanup, and it's a mess. And inputting it into your tax software, having your CPA do so, having your financial advisor aware of that, helps you avoid that risk.
Yeah, that's the primary reason why someone would wait until this time of year, till they've got a draft of their tax return in hand before they decide what accounts they're going to be funding. And this next example is one where you need to do the same thing. I'm thinking about a SEP IRA contribution. Mm-hmm. A lot of times people think of this as a profit-sharing contribution. If you're a self-employed individual, and so you've got a side hustle, maybe you do some consulting on the side, that sort of thing, and you want to reduce your taxable income for last year still, a SEP IRA could be available to you, and you're allowed to contribute up to 20% of that final profit number to your SEP IRA, and you have up until your tax filing deadline plus extensions. So you've got even extra time that you could be funding this. The point is, you can't really do a true calculation on what the allowable amount is until you've got the tax return done. And so they have to give you the time into this year and even up until September 15th to make this calculation and then make the contribution.
Have you guys seen any Roth SEP IRAs yet? It's legal. I don't think they're out. It's like endangered species here. It's legal. I haven't seen them yet.
Yeah.
You guys, any?
I have not.
Okay.
No, nope, I haven't. I saw a jackalope the other day.
And I actually think so if you're funding a SEP IRA, you're going to want to work with your CPA, work with your financial advisor, and work in your software to figure out, well, what's the max that you can do? Because I think some industries or some certain instances can be up to 25%, but there's just limits, and it can be confusing. It's not always a clear calculation, so work with your CFP on that.
Yeah. A place where that 25% calculation could come into play would be on a single K, for example.
Yeah.
So when you have a retirement plan like your own solo 401k that you're contributing to as a business owner with no employees or only a spouse as your employee, you're making potentially a couple different contributions, 2 or 3 contributions to that account. One, you could be pulling money out of your paycheck and funding your own 401k effectively, just like every other employee under the sun, as a salary deferral or an employee contribution. You can also contribute as the employer. You could have a company match piece on there. You could have a profit sharing contribution. This one, you're limited. The profit sharing contribution, I believe, is 25% of your wages. Right?
Yeah. So you're getting into, and so the salary deferral, that's if I own my own business. I don't have employees other than spouse or family members, so I don't have other employees, and I have an entity structure where I am a W-2 employee of my own business. There are lots of folks that are just sole proprietors. They have their own business. Those folks aren't bound by the payroll deduction piece. They can fund up to the tax filing deadline, including extensions.
Yeah, just like that SEP IRA.
Last one here. We said there's 5, and there's more, but Indiana 529 plan contribution. Now, I know this is, you might not live in Indiana. You might not pay Indiana state taxes. However, and so check your state's laws, but here we're recording right now in Indiana, and we've got offices in northern Indiana, southern Michigan. Indiana 529 plan, they changed the rules. You can now fund it up until April 15. However, the 529 plan needs to have been opened in the previous year, 2025. So this isn't a last minute, let's just do this, but it is one that you can now fund up to the last minute.
Yeah, you needed to already have this idea and you started implementing it before the end of the year. Now you're just funding it a little bit later. Or maybe it's an account that you've had in place for years and years, and for whatever reason, you just didn't have all the cash flow to fully fund it prior to the end of the calendar year. And the reason why we say, and I'm saying fully fund it, I'm saying at least enough to contribute and receive the full tax credit available to you. Mm-hmm. You can contribute more than the first $7,500, but in Indiana, we have some special rules that allow you to save 20% on that first $7,500. It's a tax credit. It eliminates taxes off of your state income tax bill.
Not local.
Very
state.
Powerful.
Yeah. Any others that you would say, hey, this is still an option for you to do here at the end of the tax season? Still an option to make a contribution, improve your tax picture in some way. Can't do gifts. Can't do cap gain harvesting, any loss harvesting, anything else?
I would just remind business owners or farmers, maybe you own some rental properties, maybe you put some new equipment into function or it's being used as of the end of last year. Now you have a decision to make on how you write off that asset, how you take a tax deduction. And I'm referring to depreciation. There's bonus depreciation and other mechanisms that allow you to kind of do some fine tuning on the tax return and decide, hey, am I going heavy on the tax write-off to save myself a bunch of taxes right now? Am I going to postpone or delay or slowly take that write-off over time? And the answer is, well, it depends on your situation. This is a conversation you should be having with your certified financial planner, maybe with your CPA as well, and deciding, hey, what are the levers we can pull to influence how this year's tax return and the next several might look like for you?
Yep, that's right. So whether these ideas you've already, checked them all off, I mean, then that'd be good, fantastic, because you answered then the second question. The third question, every time you're getting your tax return done, is my financial picture or my tax picture changing this year? And it needs to impact how I'm planning for my taxes. We're going to share those trends, need to be on your mind. That more coming up here on the Wise Money Show with Korhorn Financial Group. Oh,
is that 2?
It's 2.
All right.
That's 2. I'm gonna say no bonus content.
Yeah, let's roll. What's next?
So trends from 2025, and then that'll weave into top planning strategies, tax planning strategies for 2026. So this is where we'll talk about the no checks, or the IRS push towards no checks. But I listed a few other trends that I'm seeing. I don't know if you've seen any yet. So, all right. What are some trends that have occurred that we're seeing here in 2025 as you're filing your 2025 tax return in early 2026? And are any of those trends going to impact you and your planning for taxes throughout here the rest of 2026? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search The Wise Money Show. Subscribe to the show there and follow us, and also rate the program there as well. We appreciate it. Okay, so guys, we're just about to the end of tax season, and I don't know, our team prepares 2,500 tax returns or so a year, a decent chunk. Trends from this year's tax season compared to previous tax seasons. One of them is the push towards no more checks, no more paper checks from the IRS. I mentioned it earlier in the show, and that was declared a year ago, and the IRS was mum on it for a long time, and then finally admitted right at the 11th hour, we're not ready for this, but we're taking it serious. So that's where we're going. But 2025 tax season is going to be a transitional year, and so yeah, we are still accepting checks, but we might not in the future for payments. And yeah, when this one was really good. Unless it impacted you, then it's really bad. But we're still going to issue checks for refunds, but you got to prove it. Mm-hmm. And by prove it, so get this. They said if you don't want your refund direct deposited, that's fine. We'll still mail you a paper check, but you have to explain why you don't need or don't want direct deposit. And we're going to send you a notice. And literally in the memo that the IRS sent out about this, they said, your refund won't be delayed, blah, blah, blah. But then they said, we'll send you a notice. And then if you respond with a valid reason, we'll then mail you a paper check in up to 6 weeks. So that means you better have a good reason. You better be prepared to handle a notice. And your refund will be delayed. That's exactly what that means. I think it sets the stage for next year. No paper checks on refunds, period. Mm-hmm. That's my guess.
Man, I've been surprised this year. Clients who have always wanted a paper tax return and have said in the past, definitely print this. More people are accepting a paperless tax filing experience.
And our experience is fully digital now.
And even paying their taxes online already proactively. I was prepared to kind of coax them to say, hey, this is probably a year to start practicing, getting systems in place. Oh, we already paid that online. Okay, you beat me to it. I'm surprised. But, I think as generations get more and more comfortable with technology and being paperless, yes, that brings some new risks and cybersecurity and all that, but this is the direction that things are going. It's going to be more than just filing your taxes that has to be done online.
But, so to counterbalance
your
that risk,
taxes.
if you're paying your taxes, yes, it's so irs.gov/payments, and then you can click whether you want to pay from your bank account or pay via card, debit card, I believe credit card as well. I haven't done that. And then you'll pick your path, choose your own adventure there, and then you pick one, and then you have to verify your information. And they verify you if you don't have a login. They verify you by asking some details about last year's tax return, the one that you already filed. What was your AGI and what was your refund amount, or how much did you owe? Are typically the questions they ask. So you need to verify yourself. And but then when you make a payment, you can just print your confirmation right there. When you're writing a check and you put it in the mail, you're just hoping. I've seen a lot of people, I take a picture of the check and then I take a picture of the envelope and then I take a picture of me putting the envelope in the mail, because checks get lost. Well, now, not that, doing it online is riskless, but you have your confirmation right there. So that's nice.
Yeah. I think there's a lot of one trend that I've noticed is that people are filing later. Now that's anecdotal evidence, but I've done a little research, and that is a true trend. And one of the things that they say, my thinking is the companies are slower and later in getting out statements. But one of the things that my research points to, it's too complicated. And it always tickles me when I talk to my kids about financial stuff, especially taxes, because I was talking to Caleb, and he's a first lieutenant in the Marines, so he has a W-2. That's it. So he has a number that he made, and then he was trying to figure out, well, okay, I know I can see how much I've paid in. Am I going to get a refund, or what am I going to get? He's trying to figure out before he did his taxes. So I was talking him through the standard deduction. So make that make sense. And he's like, well, Dad, what is a standard deduction, and why is it $15,000?
Did he try to play the card? Well, I'm first lieutenant now, so shouldn't it be higher?
Well, this is the thing.
You mean just, it's like,
what is my standard deduction based on? It's based on your marital status. Because what?
Yeah.
And so it is so funny when you've been institutionalized, so you don't question this stuff anymore, and then someone who's a relative newbie asks a great question, and you're like, oh, dude, there's no answer to that. You
Don't
just
ask why.
Right, you just accept it. It's just how it is.
Yeah, that's funny. So so trend of filing later, a clear trend, bigger refunds, and that's not like bragging or patting anyone on the back. In fact, I would say a trend of our clients that are doing planning is not bigger refunds. It's actually filling up lower tax brackets and just crushing
bigger
it.
Roth conversions.
Yeah. Oh my goodness, the amount of tax planning this year has been incredible. But bigger refunds because senior deduction and the complicated no tax on overtime. That's another trend of make that one make sense.
Bigger standard deduction, richer child tax credit.
Or there may be more people who can suddenly itemize again. As SALT deductions change, you may have been severely limited in the past on your state and local taxes that you pay, like real estate taxes and state and local income taxes. That used to be a $10,000 limit. It's been raised to $40,000 as long as your income doesn't go too high. And that can make the difference in being able to itemize or not. If you've got some mortgage interest, if you're charitably inclined and you give to your local church or your alma mater or something like that, you start stacking up your own itemized deductions that can still exceed the standard deduction that you were trying to explain to Caleb. And you take the bigger of the two ultimately.
Last data I saw showed refunds were up about 10% from the previous year. By the end, more complicated returns are filed at the end of the year. It'll probably settle. I think last year the average refund was just under $3,000. It's higher than that this year. We'll see where the.
I thought I saw the number 3,700 or something recently.
It was 3,800, then it's 3,700. But when you compare it to the previous year, up a little over 10%, and we'll see where things land at the end of tax season. But and then another trend, and we sort of already mentioned it, but the need for tax planning. There have been more Roth conversions this year because of more deductions and bigger standard deduction because of child tax credit, like we already mentioned. But if that was an opportunity for you, Did you get penalized? Did you get a slap on the wrist by not doing it? No. You might not have even known, hey, you should have done this and you missed out. And but there's a clear trend in, we do a lot of tax preparation for the clients that we're doing comprehensive financial planning. We call it one plan, looking at all 6 areas of your financial life and infusing them together into one objective, one goal, and making sure everything's in sync. But we also do taxes for folks that aren't using us for that service. And there's a stark contrast between the two. Sure. One, you can see the thoughtfulness and the planning. I was reviewing a return from one of our advisors, Ben Chambers. He's been on the show before. He's been on some videos before. Fantastic young financial planner. And I was reviewing the return, and I didn't know it was one of Ben's clients. And I saw some of the stuff that they did, and I thought, oh my goodness, this is fantastic. They did their income was different, drastically different than the previous year, did a Roth conversion, but then we're going to, it had a lot more tax, but they did a 60-day withholding rollover strategy to avoid penalties to get the taxes paid. They ended up break even. I think they got about $100 back in refund. So it was precise, filled up the tax bracket precisely, and then avoided a penalty. And it was at the end where I was like, oh, well, yeah, this is Ben's client, of course, right? So it's that sort of creativity that you need to apply to your tax return, and it's not a luxury. With all of the tax law changes, you need to have that proactive and creative approach to your taxes. Now, what are some of the trends for 2026 that need to infuse that tax planning for you starting right now so that you've got the rest of the year to plan ahead? We've got that and more coming up here on the Wise Money Show with Korhorn Financial Group.
Okay. So do we mention the incredible increase in new clients? I mean, that, and maybe it's not interesting to the show or it's not germane, but I still think it is amazing to me that the clients that we got from folks that said, hey, I'm done working. I'm just closing the door. And
CPAs,
yeah,
tax preparers.
CPAs, yeah. And so, I mean, the number of folks that are coming to have our CPAs and enrolled agents prepare their returns, it is, I mean, there's
That's
been
a real trend.
There's been an incredible spike. I don't know if that matters in this context or not.
I mean, people who are filing this late in the season who don't have a preparer lined up.
Yeah.
Boy,
feel free to mention that.
Yeah.
Or if you got the notice, not the notice, but the heads up this year that, your tax preparer said this is their last season or whatever. So yeah, feel free to mention that. And then, let's each share 1 or 2 tax planning trends, ideas to consider for this year. So, all righty, here we go. Park on the bus.
I was saying you didn't say anything yet.
All right, land on the plane. Putting the plane in the hangar.
Parallel parking the car.
Yeah. Here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KF2 studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, as well as a lot of other content, is on the Wise Money YouTube channel and other video outlets as well. But go to YouTube, search the Wise Money Show, subscribe to the show there, and then turn on notifications so you're made aware every time we drop new content, because we've got this talk show, but also Next Rise Step videos that air all throughout the work week. We've got shorts and other, whatever really your flavor is, we've got it for you, but it's all designed to help you take your next wise step in your financial life, but from a comprehensive financial planning perspective. That's a lot of words. One plan, taking all 6 areas of your financial life into consideration and bringing synergy to them and creative ideas. Go to YouTube, search the Wise Money Show, subscribe to it there. Okay, guys, so trends, tax trends for 2026. You, as fans of the show, you know anytime you're doing your taxes, you got to answer 3 questions before you file. And that is, do I understand why I got the result that I got? Is every number in here? Am I getting the right deductions? Just do that double check. Yep, that's question number 1. Number 2, is there anything before I file this thing that I can do to improve the return? IRA deduction, HSA deduction, Roth contribution. Yeah, it doesn't impact this year's return, but it will save you taxes out there in the future. But then now question 3, And that is there anything changing in your financial life or in your tax picture that needs to impact your tax planning right meow, right? When you've got still 9 months left to change things. Like if you, for your situation, let's say, I'll just give you an example. Let's say you've got kiddos in college and you're wanting to get and have been getting the American Opportunity Tax Credit. Well, that stubborn little thing, so that's a very impactful tax credit. It's 100% of the first $2,000 of tuition and 25% of the next $2,000. So $4,000 of tuition, $2,500 in tax credits. That sounds fantastic. Yeah, here's why it's stubborn. The adjusted gross income limits, the thresholds that determine do you qualify for this or not, they haven't changed. There's no inflation adjustment to those. And you'd think with all the tax law changes that we've had and all the politicking about student loan interest and all that sort of stuff, why was that not addressed, guys? I mean,
so in other words, here's the impact. As you earn more and more money, as you get pay raises and things, it gets harder and harder to receive or get this tax credit.
That's right. And if because you have a 401k and your income's at those thresholds, you're not able to fund a pre-tax IRA at the end of the year. So if you find out about this in December or even next year when you're filing your return, you've missed that entire opportunity to shift your 401k contributions to pre-tax or increase your contributions to your 401k to get more deduction so that you can earn as much as possible but have your income below those thresholds. You need to be aware of that and make those changes now.
So in other words, anything that is tax related and paycheck related, now's the time to be considering those things. So think contributions to your 401k at work. The contribution limits go up. Maybe you just crossed a certain birth date and now you're old enough to get a catch-up contribution over age 50. That's a big birthday for a lot of people. Yeah. And if you don't go in and make adjustments to your 401k contributions, you might come up far short of where you're capable of contributing. And to Mike's point, maybe come up short of adjusting or getting your income low enough to be eligible for some pretty fantastic tax credits. I mean, you got to do it early enough in the year for your paychecks to compound and build towards that objective.
There is a clear trend with all these tax law changes that tax rates have stayed low. But that doesn't mean that Congress isn't trying to raise taxes. And one of the ways that they're doing that is more and more gimmies and gotchas. And the gotchas are based on your adjusted gross income if it's too high. And so having awareness of, well, what levers can you pull to impact your adjusted gross income that influences tax deductions you're eligible for, as well as tax credits.
Yeah, almost always those income limits are some sort of a phase out. So once you cross a certain threshold of income, you start slowly losing the tax credit or the benefit until you've reached another threshold and now you get none. And so doing what you can to make adjustments to where you're falling in that phase out can have a pretty meaningful impact on your end tax results.
Yeah, so here's a question for your financial planner. Hopefully they're leading you with this and just telling you, but hey, am I close to any phase outs that matter to me? And my tax picture. Yes. Am I near any of those phase outs that I need to be aware of? And before I get, we need a new car, so we need to pull more money out of our IRA. Before I start getting those sorts of ideas, I have awareness. How close am I?
Yeah, you want your financial planner, and make sure your financial planner is certified, but you want your certified financial planner to be helping you optimize. To me, that's the big idea. Yeah. Like, what is available to me? Which ones do I take advantage of? And as I move one lever in this area of my financial life, how does it adjust the other levers?
So here's another trend, kind of blending that one with another, and that is for those of you in retirement or near retirement, the senior deduction has been a big trend. It's a $6,000 new deduction that you get if you qualify. Well, how do you qualify? You got to be 65 or older, age 65 or older, and your adjusted gross income needs to be below certain limits. Single filers, 75 grand, married filing jointly, 150. If you're over that a little bit, it starts phasing out. Over too much and you don't get any of it. But here's the thing. So $6,000 per person if you're married, that's 12. So we're seeing more people then want to do Roth conversions, eat that up. Yes, I love that. That might be the trend that you need to be aware of. But there's another one. If you then say, I want to use that up because it's temporary. It's only around for tax seasons 25, 26, 27, and 28. I want to use that up. Now you start inviting more income into this year. And I was paying tax on my Social Security, but now I'm paying more tax on my Social Security.
Right.
Only, a quarter of my Social Security was taxable. Now the maximum 85% of my Social Security is taxable. That totally caught me off guard. You want to be aware of that now so that can impact your planning.
A lot of tax preparers have available to them the ability to not only prepare the existing tax return, but also do a rough estimate of where you might land for this current year that we're in. But their hair's on fire this time of year. They're not going to just naturally do that. You need to be asking about that type of service. This is something that a certified financial planner just bakes into the rhythm of the planning that they're going to do with you throughout the year. So hopefully this is just second nature to you. But earlier and earlier, you want to have things like those Roth conversions and other strategies on your radar. Because again, there may be some things that you could be doing early in the year to set yourself up for a great fall strategy when you're doing even more fine-tuned tax planning.
Yeah. Another trend for this year, and we're going to do a show about it. We'll do, giving shows and giving strategies and tax laws as it relates to giving, and no one watches them. That's all right. But I'll say it here, tuck it in, and hopefully it reaches the right ears. The deduction for charitable donations is changing in 2026 in a pretty meaningful way. There's always been the dividing line that if you're donating to charities, qualifying 501c3s, and you don't itemize, you don't get a benefit. That's just how it's worked. In COVID, that changed a little bit, but that's how it works. And that's still true. There's a dividing line. However, they moved it. And starting in 2026, if you don't itemize, you are eligible to get a deduction on the first $1,000 single filers, $2,000 married filing jointly of charitable contributions that you make. That's fantastic. However, the gotcha is it's got to be cash donations. It can't be goodwill. It can't be, gently used articles, blah, blah, blah. It's got to be cash donations. So you need to be aware of that. But here's the other gotcha. If you itemize, there is now a threshold. There's a floor to your charitable contributions. You're only able to deduct what's above 0.5% over your adjusted gross income. You won't be able to deduct all of your charitable contributions if you itemize. So if you are close, and we've seen, and I've been warning people of this, that, you didn't itemize or you just barely did this year, but you donated, $2,500 in cash to the church. No, next year, we're going to make sure you don't itemize so that you get this above the line deduction. We're going to talk more about that because giving strategies is a much bigger deal in your financial life, whether that's giving to charities and not that you're doing it for the tax benefit, but being aware of the tax benefits and how those rules have changed, but also giving to the next generation, giving to kids. So we'll be talking more about that, but that's another trend that might need to adjust your planning right now. So, all right. I hope that has helped you. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.